Forex trading requires a strategic approach to analyzing price movements and market conditions. Traders use two primary methods to make informed decisions: technical analysis and fundamental analysis. While technical analysis focuses on historical price data and chart patterns, fundamental analysis examines economic and geopolitical factors influencing currency values. Understanding both approaches helps traders develop well-rounded strategies suited to different market conditions. In this guide, we will explore the key differences between technical and fundamental analysis and how traders can leverage each method for success. 1. Understanding technical analysis. Technical analysis involves studying past price movements and trading volumes to predict future price trends. Traders use charts, indicators, and patterns to identify entry and exit points. The assumption behind technical analysis is that price movements follow trends and history tends to repeat itself. Commonly used tools include moving averages, trend lines, and Fibonacci retracements. Technical traders focus on short-term price fluctuations rather than long-term economic factors. This method is particularly useful for day trading and swing trading strategies. By analyzing market psychology through price action, traders can anticipate potential movements. Chart-based strategies help traders react quickly to market changes. 2. Key technical indicators and tools. Technical traders rely on various indicators to make data-driven decisions. Moving averages help identify trend directions and smooth out price fluctuations. The Relative Strength Index, RSI, measures market momentum and overbought or oversold conditions. Bollinger Bands assess price volatility and potential breakouts. The Moving Average Convergence Divergence, MACD, indicator signals trend changes and momentum shifts. Support and resistance levels indicate price points where buying or selling pressure is strong. Fibonacci retracement levels help traders determine potential reversal points. Using a combination of these indicators enhances decision-making and risk management. 3. Chart patterns and price action. Trading technical analysis includes recognizing chart patterns that signal potential price movements. Common patterns include head and shoulders, double tops and bottoms, and triangles. Candlestick patterns, such as doji, engulfing, and hammer formations, indicate market sentiment. Price action trading involves analyzing raw price movements without relying on indicators. Traders use trend lines and breakouts to confirm trade setups. Volume analysis helps assess the strength of price movements. Understanding how patterns repeat allows traders to anticipate future price behavior. A strong grasp of chart patterns improves accuracy in trading decisions. 4. Understanding fundamental analysis. Fundamental analysis evaluates economic indicators, interest rates, inflation, and geopolitical events to determine currency value. Traders assess macroeconomic trends to predict long-term price movements. Central bank policies and interest rate decisions significantly impact currency strength. Economic reports such as GDP growth, employment data, and consumer sentiment provide insights into economic health. Political stability and global events, such as trade agreements or conflicts, influence market sentiment. Fundamental traders take a long-term approach and focus on economic cycles. Understanding economic fundamentals helps traders make informed investment decisions. This method is widely used by institutional investors and hedge funds. 5. Key economic indicators in Forex. Fundamental traders monitor specific economic data releases to gauge market direction. Gross domestic product, GDP, reflects a country's economic performance and growth rate. Inflation data, including the Consumer Price Index, CPI, indicates purchasing power and potential interest rate changes. Employment reports, such as non-farm payrolls, NFP, affect currency valuations significantly. Central bank statements and interest rate decisions set monetary policy and influence Forex trends. Trade balance reports reveal a country's import-export relationship and impact currency demand. Political events and government stability also play a crucial role. Keeping track of these indicators helps traders anticipate market movements. 6. Interest rates and their impact on Forex. Interest rates play a crucial role in currency valuation and Forex market trends. Higher interest rates attract foreign investment, increasing demand for a currency. Lower interest rates can weaken a currency as investors seek higher returns elsewhere. Central banks, such as the Federal Reserve, European Central Bank, and Bank of Japan, set interest rate policies based on economic conditions. Traders analyze interest rate differentials between countries to identify profitable trading opportunities. Anticipating rate hikes or cuts helps traders position themselves effectively. Monitoring central bank speeches provides insight into future policy changes. Interest rate decisions create significant volatility in Forex markets. 7. Comparing technical and fundamental analysis. Technical and fundamental analysis serve different trading styles and timeframes. Technical analysis is more suitable for short-term traders focused on price action and market trends. Fundamental analysis benefits long-term traders who consider economic health and monetary policies. While technical analysis provides precise entry and exit points, fundamental analysis offers a broader understanding of market direction. Many traders combine both methods to enhance their decision-making. Technical tools help time trades effectively, while fundamentals provide context for market movements. Understanding the strengths and limitations of each approach allows traders to develop balanced strategies. A hybrid approach improves adaptability in various market conditions. 8. The role of sentiment analysis in Forex trading. Sentiment analysis measures market psychology and trader positioning to gauge future price movements. Forex traders monitor commitment of traders, COT, reports to assess institutional investor sentiment. News sentiment and social media trends influence short-term price volatility. Bullish or bearish sentiment drives trends, reinforcing or reversing market directions. Retail trader sentiment can act as a contrarian indicator, signaling potential reversals. Sentiment analysis works well when combined with technical and fundamental approaches. Identifying extreme sentiment conditions helps traders avoid market traps. Keeping track of market sentiment provides an additional edge in Forex trading. 9. How to use both approaches for better trading. Integrating technical and fundamental analysis enhances overall trading effectiveness. Traders can use fundamental analysis to identify major trends and technical analysis for timing entries. For example, if economic data supports a strong currency, technical indicators can help find precise buy opportunities. Combining technical and fundamental insights reduces reliance on one method and improves trade accuracy. News-based trading strategies can benefit from technical confirmation signals. Regularly analyzing macroeconomic factors helps traders anticipate long-term trends. A multifaceted approach ensures traders are well prepared for diverse market conditions. Flexibility in using both methods enhances trading success. 10. Choosing the right approach based on trading style. Traders should choose their analysis method based on their preferred trading style and time commitment. Day traders and scalpers rely heavily on technical analysis due to short-term market fluctuations. Swing traders may use a mix of technical and fundamental insights to capture medium-term trends. Long-term investors prioritize fundamental analysis to make strategic investment decisions. Risk tolerance also influences the choice of analysis method. Experimenting with both approaches helps traders find what works best for them. There is no one-size-fits-all strategy, so adapting based on market conditions is essential. Choosing the right approach enhances confidence and consistency in trading. Both technical and fundamental analysis play vital roles in Forex trading. While technical analysis focuses on price action and short-term trends, fundamental analysis considers economic and geopolitical factors. Successful traders often use a combination of both methods to gain a comprehensive market perspective. By understanding the strengths and applications of each approach, traders can develop well-rounded strategies suited to their trading style. Whether focusing on charts or economic indicators, the key to success lies in discipline, risk management, and continuous learning. Mastering technical and fundamental analysis enhances decision-making and improves overall trading performance. Thank you for reading this guide on technical versus fundamental analysis in Forex trading. If you found this information valuable, don't forget to like, share, and subscribe for more insightful content on trading strategies. Stay informed, stay disciplined, and happy trading.